Welcome to a new video where we analyze the stock market with dynamic charts that make information easier to understand. Today we are going to analyze the evolution of Rivian, one of the most followed companies in the electric vehicle sector. Throughout the video, you will see a dynamic chart that we have created based on the image on the screen, allowing us to clearly visualize how Rivian's deliveries have changed and what we can expect in the future. Understanding the data and evolution of a company like Rivian is crucial because of its impact on the electric vehicle industry, a market that has experienced explosive growth in recent years. Since Tesla emerged as the sector leader, followed by the entry of new competitors, electric mobility has transitioned from a future promise to a present reality with significant implications for the global economy. Rivian was founded in 2009 with the goal of revolutionizing the electric vehicle market, focusing on high-performance pickup trucks and SUVs. However, it was not until 2021 that the company made its stock market debut in one of the most anticipated public offerings in the automotive sector. At one point, it reached a valuation exceeding $100 billion, directly competing with giants like Tesla and Ford. The initial enthusiasm for Rivian was enormous, partly due to its partnership with Amazon, which invested in the company and placed an order for 100,000 electric delivery vehicles. However, as we will see in the dynamic chart, Rivian's story has not been just one of growth and success. Rivian's rise also coincided with a period of high liquidity in financial markets, where investors were eager to bet on disruptive new technologies. During those years, the valuations of many tech and electric vehicle sector companies reached record levels, with the expectation that electrification growth would continue exponentially. If we look at recent performance, Rivian delivered 51,579 vehicles in 2024. For 2025, the company has projected a delivery range between 46,000 and 51,000 units, implying a potential decline in production. This is a key figure since, in the automotive sector, especially in electric vehicles, volume growth is essential for long-term profitability. But what is happening with Rivian? One key factor is access to capital. Recently, Rivian finalized a deal with Volkswagen and also received a loan from the U.S. Department of Energy for up to $10 billion. This financing is crucial for the company to continue its expansion and improve its production efficiency. Another fundamental point to analyze is the evolution of production costs. Unlike Tesla, which has optimized its production chain with highly efficient gigafactories, Rivian still faces challenges in reducing costs and achieving a scale that allows it to generate stronger profit margins. Additionally, Rivian's efforts to streamline its supply chain have faced obstacles. While it has sought greater vertical integration, sourcing raw materials and ensuring stable component availability remains a challenge, particularly given the rising costs of essential materials like lithium and nickel. Now, let's look at the dynamic chart. Here we can observe how Rivian's deliveries have evolved since its IPO to the present. As you can see, the trend was one of consistent growth in the early years, but with some recent slowdown. In 2023, the company delivered over 50,000 vehicles, but the estimate for 2025 suggests that we might see a stabilization or even a slight decline in deliveries. Why is this important? Because in the automotive industry, production and delivery numbers not only reflect demand but also the company's ability to fulfill its promises to investors and customers. Market confidence in Rivian will largely depend on its ability to sustain steady production growth. Analyzing dynamic charts allows us to see delivery trends and link them to key events that have impacted the company. For example, we can note that delivery growth in 2022 and 2023 coincided with significant investments in production capacity and the company's expansion into new markets. However, the forecast for 2025 suggests that the company may be facing difficulties in scaling up production. Furthermore, the cost per unit of production remains a critical concern. Unlike legacy automakers, which can offset lower-margin electric vehicle production with profits from their internal combustion engine divisions, Rivian operates solely in the electric segment, meaning it must find a way to make each vehicle profitable on its own. One of the biggest challenges Rivian faces is the increasing competition in the electric vehicle sector. While Rivian has positioned itself as an innovative brand with differentiated products, it is under pressure from industry giants also seeking to dominate the market. Tesla remains the undisputed leader in the sector, with a highly efficient production infrastructure and a well-established global charging network. Its recent price cuts on key models have increased pressure on Rivian, which is still struggling to achieve economies of scale. Meanwhile, traditional companies like Ford and General Motors have intensified their push into electric vehicles. Ford, with its F-150 Lightning, is directly competing in the same electric truck segment as Rivian, offering competitive prices and a well-established brand reputation. General Motors has also accelerated its investment in developing new electric models with advanced technology. In addition, new startups like Lucid Motors and Fisker are looking to gain market share with high-performance and luxury vehicles, further diversifying the range of electric cars available and making differentiation increasingly difficult for Rivian. The industry's competition is becoming fiercer, forcing the company to improve its efficiency and market positioning. Another competitor to consider is BYD, the Chinese electric vehicle manufacturer, which has rapidly expanded its global footprint. With its aggressive pricing strategy and government support, BYD has been able to capture significant market share in multiple regions, including Europe and South America, which could present additional challenges for Rivian in its international expansion efforts. When a high-growth company like Rivian faces a slowdown in deliveries, markets tend to react with volatility. If the 2025 delivery projections remain at the lower end of the estimated range, we could see a negative reaction in the stock price. On the other hand, if the company manages to exceed expectations with stronger numbers or strategic announcements that boost its profitability, the market could respond positively. Rivian is at a crucial point in its evolution as a company. While it has made significant advances in the electric vehicle sector, its ability to stabilize deliveries and maintain access to financing will continue to be determining factors in its future. The dynamic chart has allowed us to visualize how its performance has changed in recent years and what we might expect moving forward. As always, the key is to analyze the data and understand the context in which the company operates. Before closing, I invite you to check out our latest video, where we compare the P/E ratio of Palantir and Snowflake and explore which of these two companies might have greater upside potential in the coming years. See you in the next analysis.